Hi there, ladies and gentlemen. I'm Jonathan Takadena. I'm a dealer here at Mink Trading, and basically just going to run through a little seminar here, taking the mystery out of options. Now, options are often connotated as having high risk involved with them, and what I usually find with clients is that it's basically just a lack of knowledge. So the whole point of this webinar is just to basically just give you the foundations so that you can actually make a decision for yourself. Okay? Now, options were actually invented as risk management tools. Now, the thing with risk management is that they can actually, it's just the way that you actually go about the whole process. So just like with trading shares, you can day trade and take high risk there. You can just hold and hope and take high risk there. The whole point with options is just getting you to think about it in a way that you're actually taking the risk out of the equation, or actually managing the whole process there. And the thing that's unique about options is that whatever opinion you have in the market, whether you think it's going to go up, down, sideways, or even if it's just going to go somewhere and you don't even know the direction, there is a strategy where you can actually make money from it. And that's the unique thing about options. Let's start with options are just insurance contracts. If you actually bought a new car, you want to take some insurance out on it. So, most people want to insure their new car, their house, or things like that. Well, it's pretty much the same thing with options. If you have a portfolio that you want to protect, all you're doing is just buying some insurance for it. Okay, and as you'll hear down the track, it's actually all you're doing is just buying a put option on the contract. In the house example, you want to participate in an up move, so all you're doing is actually just buying a call option on it. And the easiest way to think about it is that it's just a security deposit. So with that, you have puts, which are just actually insurance policies, and calls, which are actually just like security deposits. Obviously, there's going to be a little bit more detail involved when you're actually dealing with certain stocks, exercise prices, and things like that. But if you can just think of them options as just insurance policies, then you're actually probably half the way there in terms of understanding them. So if you actually think about what insurance companies do, they're actually just out there selling puts to you. And we'll actually discuss that as a business model later on. As I've mentioned before, in the world of options, there's only two types, okay? Call options and put options. So call up, put down. So call up, if you're buying them, basically calls will increase in value. If you buy puts, they increase in value if the underlying goes down. Now the key to this whole thing, and it often gets confusing to most people, is that it's just the actual contract that goes up, or the value of the contract that goes up or down based on the underlying. They often get the two confused, and if you get that distinction right, it just makes the whole thing clearer. So if you're buying calls, if the underlying goes up, you just make money. Simple as that. And with puts, if the underlying goes down, you make money on the insurance policy. So now that people are actually familiar with stocks, it's just a good way to think about what options and stocks have in common. Okay. Now, the same thing that what options and stocks have in common is that options are just like securities. So basically, you can just buy and sell them. So if you want to buy an option, you make a bid. If you want to sell an option, you make an offer. And it's the same thing with stock. One thing they do have in similarity is that once they are all traded on exchange, they can just be traded freely and available. Just like any other stocks, buy and sell as many as you can. Now, the main differences between stocks and options is that options are a derivative. Meaning that if you have a stock, basically it can either go up or down, okay, just based on the value of the stock. With options, their value is derived from a value. So if a stock goes up or down, that's what determines the value of your options. And probably the most unique thing, or the most unique difference between the two, is that options actually have an expiration date. With stocks, you can hold that company for as long as you want. Microsoft for 100 years, things like that, and there is no expiration date. Basically, just as long as you hold that stock, you own a piece of that company. With options, usually there's expiration dates every month or quarter, depending on what the underlying is, and so you have to trade the underlying differently to where you're coming from. And the last difference is that options, obviously, they don't give you any rights over the actual stock. So even though if you're a stockholder, you can actually vote at the AGM. Fortunately, if you just own the call option on the stock, it doesn't give you any rights whatsoever. This is one of my favorite topics, and that's actually why do we use options. Now, my favorite topic is obviously speculation, because we are Ming Trading here. We enjoy speculation. Now, the beauty of options is that they give you versatility and they give you leverage. So the thing is, if you actually think a stock's going to move up or down, you can actually profit from that and actually gain more leverage using options. Now, the other use of options is actually through hedging. Now, most people are familiar with hedging if prices go down. As an example is the stock market. So if you think the value of your shares are going to go down, you can actually buy some insurance for if it falls. Now, the other hedge is actually protecting yourself if prices rise. So think of an example. If you're an airline and you have large fuel costs, you might want to hedge against a rise in fuel, and you actually buy some options to protect against the rise in prices. One thing most beginners think of with options is that they're risky. And the reason why they think they're risky is that when you actually buy options, you actually have to get a lot of factors right rather than just buying straight stock. And so they think, hang on, I've just bought an option and now I've actually got the direction right, but I didn't make any money. Well, guess what? The thing with options, and what I want to get you thinking about, is actually that you can buy and sell options. Okay? So let's think about the two types of options and the two types of transactions. You can buy a call. So what you want to do is buy something that goes up. You can be a seller of a call. Okay, so you sell it against it going up. You can buy a put, so you can buy it for going down, or you can sell it for going down. So the reason why I'm actually going with those 4 examples is that if you think something's going to rise in price, you can actually buy a call or sell a put. Now, there's little differences between the two, but they're still basically going to profit if the stock rises. Now, let's just say you think a stock's going to fall. You can actually buy a put or sell a call. Same thing on the other end. So there are differences involved, but they're profiting from the same type of movement, and there are different risks involved. So the main difference between buyers and sellers is that people who buy options, and this is why people are comfortable with it, is that you're just buying an option, meaning that whatever happens, the premium that you paid is the most you can lose, and if nothing happens, basically you're not obligated to do anything. Now, the other side of it is that if you're a seller or a writer of an option, if the buyer of the option exercises their right, you're obligated to do something, and most people aren't comfortable with that. And the reason why I'm actually just harping on this fact is that if you think buying options is risky, why don't you just take the other side and sell some? Now, think about insurance companies. Okay, how do they run their business models? Basically, they take 100 people, sell 100 puts there, and hopefully not everyone's going to exercise it, and hence they make a profit. So have a think about the insurance company. Are they doing something risky? Just some food for thought there. Okay, let's just recap a few things about this introduction to options. Now, dictionary meaning: an option is a contract giving the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. Options are derivatives. Because they've derived their value from something else, that's where the term comes from. Now, a call gives the holder the right to buy. A put gives the holder a right to sell. Don't forget, there's 4 types of participants in the markets: buyers of calls, sellers of calls, buyers of puts, and sellers of puts. And 2 reasons that people use options, and that is to speculate and to hedge. So in conclusion, that's just a small intro to options. It's basically just scratching the surface, but hopefully it gets you thinking about the options business as a business, and thinking about them as insurance policies, and getting your head around maybe how can I actually profit from that. Okay, a lot of people think they're risky. Because they're a risk management tool, there are certain ways to actually manage that and actually profit from that. And we'll see that in following webinars from here. Okay, thanks a lot.